Welcome to The Explainer. Today, we're diving into a fascinating market strategy that paints a picture of two wildly different years for the Turkish markets. We're talking about 1 year of pain and patience, followed by another year of huge opportunities and major splits. So, let's break down how to navigate this tale of 2 years.
So, with all these mixed signals flying around, the big question on every investor's mind is, what's coming next? Are we heading into a massive opportunity, or are we sailing straight into a storm? Well, according to this strategy, the crazy part is, the answer is both, and knowing the difference is everything.
And this slide right here, this really gets to the heart of it. 2025 is basically the setup year. It's all about patience, about getting through the necessary economic transition. But that pain is exactly what paves the way for 2026, a year where some things are going to soar while others get left in the dust. This is not a market where a rising tide lifts all boats. It's going to be all about being selective.
Okay, so to really get this tale of 2 years, we have to start with a recent move by Turkey's central bank that, on the surface, just doesn't seem to make a lot of sense. And this one move really defines the entire story for 2025.
I mean, it seems like a total contradiction, doesn't it? The central bank has been going all out to fight inflation, but then in October, they went and cut their main policy rate to 39.50%. So you have to ask, how on earth do you fight rising prices by making money cheaper?
Well, there's a term for this, and it's a good one: hawkish easing. Yeah, it sounds like an oxymoron, but the idea behind it is pretty powerful. The bank isn't backing down from the inflation fight. Instead, this small cut is meant to be a signal of confidence. It's them saying, we think the worst is over. They're moving from a sledgehammer phase to a scalpel phase.
And look, this confidence isn't just them hoping for the best. It's built on some really solid ground. We're talking record-high gross reserves, a massive drop in those currency-protected deposits, and as a result, more people are holding regular lira deposits. All of this gives the central bank the breathing room it needs to start fine-tuning.
Okay, so how does all that macro stuff actually play out in the stock market? Well, the whole strategy is built around this idea: first 2025 for 2026. The thinking is pretty simple, really. You have to get through the tough market of 2025 if you want to be positioned for the big opportunities coming in 2026.
And the potential rewards for that patience, they look pretty good. Even with the sluggish economy expected in 2025, the 12-month forecast for Istanbul's main stock index, the BIST 100, is actually pretty bullish. This forecast from Deniz Yatırım is targeting 14,000, which is a potential 40% upside from here. Not bad, right?
But, and this is a huge but, that 40% growth is not going to be evenly spread around. We're expecting a major split. On one side, you've got cyclical sectors like banking, which are getting squeezed hard by high interest rates. And on the other, you have these structural growth stories like the defense industry, which is basically running on its own engine, powered by huge export demand that doesn't really care what the local economy is doing.
This just proves that being selective is going to be absolutely critical. I mean, take a look at this HSBC analysis. Even within the banking sector, it's not one size fits all. They actually upgraded their target for Garanti while downgrading others in the same space. It all comes down to which companies are strong enough to weather the storm of 2025. All right, now let's pull the camera back a bit, because there's another major divergence happening between the global economic picture, which is looking kind of gloomy, and Turkey's local story, which might just have a light at the end of the tunnel.
The theory goes that the Turkish economy is about to trace a classic J-curve. You know what that means, right? You have to go down before you can shoot back up. So that painful slowdown we're expecting in early 2025, that's actually part of the plan. It's the necessary dip before the recovery really kicks in. It's the pain before the gain.
And hey, this isn't just some local optimism. The IMF seems to be on board too. They actually upgraded their 2026 growth forecast for Turkey. That's a pretty big vote of confidence, and it suggests they believe in a real recovery that could split away from the downbeat trend we're seeing elsewhere.
So what is that downbeat trend? Well, the global outlook is pretty much dominated by one big, ugly word: stagflation. That toxic cocktail of zero growth and high inflation. It's the worst of both worlds.
And if you want to see hard evidence that big investors are preparing for the stagflation world, you don't have to look any further than the dramatic, almost historic split we're seeing between different asset classes right now.
First, just look at the forecast for gold. It is absolutely wild. We're not talking about some fringe call here.
We're talking about major players like Goldman Sachs saying gold could hit $4,000 an ounce. That's not just a hedge, that's a massive flight to safety. Now let's flip the coin completely over and look at oil. The forecast here is deeply pessimistic. You've got the U.S. Energy Information Administration and others seeing a world where oil prices could actually drop below $50 a barrel, simply because they expect global demand to be so weak.
So you put those two things together, gold to the moon, oil in the basement. What does that tell you? It's simple. Investors are buying monetary fear through gold, and they are selling economic growth through oil. That is the global stagflation trade, clear as day.
Now, let's switch gears to digital assets, because we're seeing another fundamental shift there too. The whole structure of the market has shifted. It's not about retail speculators anymore. The dominant players, the new whales, are huge institutional giants like Strategy and Bitmine, and they are buying up massive amounts. We're talking single companies holding almost 3% of the entire world's supply of Bitcoin.
And this has kicked off a really interesting debate. You got one side, like Bitwise, saying the old, predictable 4-year crypto cycle is dead. It's all about what the Fed does now. But then you have another camp, like Diaman Partners, saying, no, the cycle isn't dead, it's just evolved. They think the cycle continues, just with much higher lows, maybe in the $60,000 to $80,000 range for Bitcoin.
So the consensus seems to be that the cycle hasn't ended, it's just transformed. These new institutional buyers aren't day trading, they're in it for the long haul. And this creates a new reality. The era of those soul-crushing 80% plus crashes, the crypto winter, well, that might be evolving into something milder. Maybe something more like a crypto autumn.
Okay, so let's tie all of this together. With all these splits and divergences happening everywhere, how do you even begin to build a roadmap? Well, it all comes down to one thing: filtering out all the short-term noise so you can focus on the long-term signal.
So here it is. The whole playbook is built around these 4 key divergences. You've got the macro divergence, betting on Turkey's positive story versus global stagflation, the BIST divergence, balancing the comeback plays with the steady growers, the commodity divergence, positioning for that gold up, oil down world, and finally, the digital asset divergence, understanding that it's a whole new institutional game in crypto now.
So at the end of the day, the crucial takeaway from all this analysis is actually a pretty simple message. All the stuff that's going to happen in 2025, the volatility, the weak earnings, the slowdown, that's the noise. The real opportunity, the real signal lies in focusing on what's emerging for 2026 and getting positioned for the new cycles that are just getting started.